Hello everyone and welcome to Stock Navigators Options Series Chapter 1. In this video, I will go over the definition of options. If you are new to trading and you heard people talk about trading options, how they make a huge profit on a very small investment, and you got curious but you don't know what options are and how to trade them, so this video is for you. Let's get into it. So, what are options? Options are financial instruments that derive from stocks. So most of the stock trading in the market will most likely have an option associated with it. So option are just contract that associated with the underlying stock. However, options allow traders to make bigger potential profit with a very limited risk. There are two types of basic options, calls and puts. Each option or each contract has an expiration date and all the properties associated with it. Sometimes you can hear the terms like delta, vega, gamma, theta. So those are the Greeks, the properties associated with each options. And we will talk about the Greeks and their properties in another video. In this video, I will just briefly go over the basic definition of the options. You can understand it. So each call or put option or contract equals 100 share of the underlying security. For example, if you talk about trading one Tesla contract or either call or put contract, that means that one contract equals 100 share of Tesla. Or if you trade 5 Tesla contracts, that means you are trading or you have the right to buy 500 shares of Tesla. So what are the difference between calls and puts? So I will explain about the mechanics, the difference between them. With the call, by nature, the call will gain value when the underlying stock goes up. So for example, on this chart, I have the graph of, let's say, Apple. Assuming Apple is trading at $163, and you think that in the future, in the next couple months, the price of Apple will go up. So you purchased $163 call, meaning at the money. And we will talk about, at the money, in the money, or deep in the money, or out of money options in another video. But let's say stock is trading at $163, and you just buy a contract at the same strike or at the same price as the trading stock, and you purchase this $160 call expiring in 90 days for the price of $5 per share. So each contract is equivalent to 100 share. So that means $5 per share. That is $500 per contract. So let's say in the next 2 months, if Apple price goes up to $175, so your option will also gain value as well. So you pay $500 out of pocket to purchase this option, and now it's worth $1,200. So you made $600 in profit, or 120% rate of return. Also, note that option price will change with respect to the underlying stock price, or the Greeks, or the market condition, meaning if there are more volatility coming into the market, that will also affect the price of your option as well. So let's talk about the put. The mechanics of the put is the complete opposite with the call, where the put will gain value when the underlying stock goes down. For example, I would use the same example with Apple, where let's say Apple is trading at $175, and you think that Apple price will go down in the next couple months, then you can purchase a put at the money, meaning you can purchase the put price at $175 strike price, same as the stock trading price, and expire in 90 days from now for $500. That is the cost or the premium that you have to pay out of pocket to purchase the put option. So let's say 2 months from now, the price of Apple goes down to $163, and your put option will gain the value. Maybe it's worth $1,200 now, and again you will gain $600 profit, or about 120% rate of return. Again, option price will change as well, regardless if you buy calls or puts. The value will be affected by the market conditions and the underlying stock price. So now you may ask yourself, why do I trade option? What is the difference between trading options and trading stock? So here's the answer. So this is an example where our head trader Tom Lu traded the Moderna stock a couple months ago, where Moderna was trading at the price of $400 market price. So let's say if you buy 100 shares of Moderna at that time, you would have to spend $40,000 to buy the shares. So when, let's say, Moderna went up to $455, obviously the value of your 100 share now increased to $45,500. So the net profit that you have from this trade is only $5,500, and the rate of return is only 13.8%. However, Tom purchased a 10 call buy call on Moderna at $44.36 per share. That translates into only $4,436 per contract. So let's say if you don't have a large capital like Tom, you only want to buy one contract. So in this scenario, when Moderna stock price trading at $455, now the buy call contract that you bought now increased to the value of $100 per share. So the net profit for you in this trade is $5,564 per contract. However, if you look at the rate of return compared to trading stock, now your rate of return on trading option is actually 125%, because your initial investment when you purchased it by contract is only $4,436 compared to $40,000 if you were to trade with buying shares. That is the key difference between buying options and buying stocks. Here is another example from one of our member of our active trader Discord. Sam, he purchased a different Apple contract at different strike price. As you can tell, he purchased $155 call, $140 call, $145 call as well. And if you look at these gains, obviously Apple just move up like, let's say, 10 points, and his contracts already gain 87%, 51%, or 45%. So that is the power of trading options. So if you like this video, please give us a like, subscribe, so you can get notified when we post new lessons. Thank you for watching, and have a good day.